I've been a professional options trader for almost 30 years. I was one of the youngest option market maker specialists ever on the open outcry floor with all the yelling and hand signals like you see on TV. It was an incredibly chaotic but fun and exhilarating environment. I then turned to a role as a senior portfolio manager for one of the largest ETF companies, directly managing a number of discretionary option overlay income funds that used covered calls, cash secured puts, and importantly, downside put protect strategies. I like to teach offense and defense. In all, I've managed $1 billion in option strategies, and I've generated $750 million in options cash flow for investors around the world. And during the course of this talk, you're going to learn a few of the little secrets that I've picked up along the way during my journey. Today, we're going to talk about options versus stock. What are the advantages and disadvantages to using one or the other? We'll discuss an important option Greek called delta and how it serves as a versatile tool for us to use in a number of ways. We'll talk about time being either an ally or a foe, depending on what kind of option trade we consider. And that's going to bring us to our second Greek called theta. And so we'll see how these concepts work together through time, because we have to remember that options are quite different from stock in that their behavior adjusts through time and space. Space with, of course, the movement of the stock, and time being a factor because options are instruments with a limited lifespan, unlike most equities. And then we'll finish off by touching upon one of my very favorite underrated strategies, which is the risk reversal, a really cool way to express some upside for very little or no cost. So let's get going. Why trade options over stocks? So number one, less capital requirements. So less of an outlay of actual cash in order to create an upside or a downside profile that you're thinking about creating with a stock or maybe shorting stock. You can do that with a lot less money using options. Number two, make money from up, down, and sideways moves. So with stock, well, we can generate things like dividends. So even in a sideways market, we're going to be generating dividends. But options allow you to supplement that with some income from monetizing that sentiment that is out there in the form of calls and puts. And so we can create more income on top of the dividends that we're already getting, or we can create a dividend of sorts to begin with. So on a stock like Tesla, for example, that doesn't generate a dividend, you can generate one from the options market. So that's really great. You can turn a stock or something like GLD, gold, you can turn something that otherwise normally wouldn't pay anything into an instrument that actually generates some sort of return, which is really great. It's a different kind of return. The structure of the income is a little bit different from a dividend income, but nonetheless, you're creating some sort of return from that. Number three, make money from time and volatility. So as the passage of time occurs, you can actually, depending on the strategy you're using, you can generate some sort of income flow from that. And making money from volatility. So what are we doing here? Well, we're monetizing sentiment, right? We're taking the sentiment that is out there. Options represent what the market is thinking about what could happen. And that might happen and it might not. But right now we can turn that into cash flow by selling options and turning that sentiment into a return. Number four, manage risk. So we can use options to manage risk, to lower volatility in portfolios, to decide on where we're going to buy a stock, maybe where we're going to sell a stock. You can set a cover call to decide, well, I'm going to sell a stock right here and I'm even going to get paid for that. So a really great way to approach different things that you might normally do in the market. You can do things like buy puts, which is basically like buying an insurance contract for your underlying stock or your underlying index that you hold. And in the same sense that you would buy house insurance, you can buy insurance on a particular part of your portfolio. And that costs a little bit of premium, but it protects you below a certain point. You can also do things like call selling. That creates a little bit of a hedge. Depends how aggressive you want to be. You can sell out of the money calls, which would be less aggressive. You can sell at the money. You can sell in the money. So depending on your viewpoint and what things are doing out there and what the market's doing, you can adjust that. That's one of the things that we do in the Cash Flow Insider system is we make those adjustments based on the indicators. So cool ways to hedge portfolios, to lower volatility in those holdings. What we use in the world of option trading quite a bit is a Greek called delta. And what delta does is it approximates what this option is going to make or lose on a $1 move in the underlying stock. So the advantage to that is it gives us an idea of, well, if I want to build a position that's going to hopefully make me $1,000 on a 10% move up in the stock, I need to know, well, what combination of options or how many calls do I need to own or how many puts do I need to short in order to arrive at this goal? And delta helps us to figure that out. So the delta of stock as a benchmark is 100, because when a stock moves $1, the stock is moving 100% of itself. So it's clear that the stock is moving $1. And so very clear, stock has a very linear relationship to price. And we can see that here, that up and down, the stock up $3 or $4, we make $3 or $4 on this particular holding of 100 shares, and down $3 or $4, we lose $3 or $4 times 100 shares. So very linear relationship, very, very clear to us. So stock has 100 delta. That's important because when we start looking at options, we're going to notice that they have different deltas because they're going to have a different behavior relative to what the stock is doing. An out of the money call is going to move differently from an in the money call or an at the money call. So delta is going to really help us to start to formulate an idea of what kind of position and what size of position we need to achieve a certain goal in our option trade versus the underlying. So let's take a look at that. So if we take a 165 call, so I'm going to go back to the option chain. This is a platform called Thinkorswim. It's owned by Schwab, used to be owned by TD Ameritrade. And so Schwab runs this now. Very good platform. I can recommend it. I don't get anything from that, but terrific platform, really great position, volatility, option position analysis software, as you're going to see in a moment, because I'm going to show you some pretty cool stuff. Very, very robust. I recommend it compared to many other platforms that are out there. So as we can see, on the left side here, we have calls. On the right side, we have puts. Down the middle, we have strike prices. So from 90 all the way to 175. And we happen to be looking at the month of June with a 21st expiry, June 21st expiry. So these are about a month away for us, a month and about a week based on today's date. So these options expire in about 5 weeks. And what we can see is the bid and the ask for these options. So the market makers or the marketplace is bidding $430 for the 170 call, and those calls are offered at $440. So pretty good spreads, 10% spread or 10 cent spread rather on a $4 option. That's not bad. The 165 is $6 bid, offered at $610 for you to transact in those. So pretty good spread there. And what we're going to notice is this column here called delta. So we have a delta of 45 on the 165 call that expires June 21st. So what that tells us again is that this particular call is going to move roughly, and this isn't an exact science because there are many factors involved here, but this option should roughly move about 45 cents for a $1 move up in the stock or a $1 move down. And that's important to us because as we formulate a position that we want to look like long 100 AMD, because that's our goal here, we want an option position that is going to approximate what this looks like in terms of upside P&L. We know that on a 10% move, if we look at our price slices in the middle here, a 10% move up, I'm going to make $1,600 because a 10% move up is $16. 16 times 100 shares is a P&L of $1,600. I want to see if I can approximate that using options. So what I'm going to do is I'm going to buy one of the June 165 calls, which is a 45 delta. So that call is going to move about 45 cents for each $1 of movement in the underlying stock. So let's take a look and see what that looks like. Here we go. So what this gives you is it gives you an expiry graph as well as a real-time graph of P&L. So this is pretty cool because the real-time graph is in this sort of pinkish color. And what it's showing you is that From here, where the stock is trading right now at 160, just under 160, if we move up to 165, we're going to make about $246. If we move up to 176, which is what we were looking at before, we're going to make about $987. Do you see this number right here? So we're going to make about $987. That's a little bit more than half of what we would make being long 100 shares. So why are we making the $1,600 that we would have made on a long 100 share position? That's because our delta is only 45 on this call. So this call is only acting like 45% of the stock. It's only giving you an impact of 45% of the stock from a P&L, from a profit and loss position. So what do we need to do? Well, we need to buy an extra one, because if I buy 2 of these calls, I now have 2 45 delta calls. Each call is a 45 delta. 2 of them together is going to be 90 deltas. Now we're getting closer to the 100 delta position that long 100 shares gives us. So let's take a look again at what this looks like. Up at 176, I'm now up $1,974. So I've done a little bit better, because what happens is as you start to go through 165, these options actually become a different delta. So this is starting to get a little bit more complicated here, but it's important for you to know that it doesn't equate to the 90 shares times $16 exactly, because option pricing and option behavior evolves through time and space. And by space, I mean going from 160 to 176, and through time. Time hasn't elapsed, so this line is just giving us what we would make immediately right now. So time is not a factor at this point with our pink real-time P&L line. But what's happening is, as a call starts to go through the strike price, which is 165 right here, it starts to acquire a higher delta. So this is about a 50 delta. As it goes to 170, it's probably about a 55 delta, and so on and so forth. By the time it's up here, it's accelerating in value. So this is getting a little bit more in depth here, and that's why this doesn't approximate to 90 shares times the $16 move. But what we've succeeded in doing is we've created a position that is going to roughly look like 100 shares by combining 2 calls together at the 165 strike and approximating about a long of 90 deltas, which is 90 shares. Remember, your delta is telling you roughly how many shares it's going to act like. So 45 delta means it's going to act like being long 45 shares. If I own 2 of those, it's going to act like I'm long 90 shares. So here we are, we've succeeded in creating a position that's making at least as much as we were going to make from straight up stock position. So that's one of the cool things about Delta, is that it allows us to now start to look at a position and say, I would like to make X amount, right? If I'm going to allocate 10% of my portfolio to being long AMD, I need it to act like the allocation that I want to create. Otherwise, I'm going to make maybe too little, and it's not going to be impactful to my portfolio. Or if I make too large of a position via options, it's going to put me at risk because I put on too much risk. I bought too much premium. I'm going to potentially make a lot more, but that's not the idea here. The idea is we want to go in informed and to understand in fairly certain terms how this position is going to act. So again, I'm going to come back to this line here. So this is our real-time line. Now, what is this other light blue line? This is our expiry line. So what this is what the option is going to be worth based on where the stock is on expiry, right? So basically, the minute that this option expires, it is going to either be worth something or it's going to be worth nothing. So under 165, it's going to be worth nothing because it's not in the money. The strike is 165, and if the stock closes at 164, well, this is an option, if we've bought it, that is now worth 0. And we've lost $6.10 that we've invested in it, which is going to be reflected in our P&L. So we've lost about $1,200, right? So it's showing us here we've lost $1,220, which is the cost of 610 times 2. Because $6.10 we multiply, remember, each contract is worth 100 shares. So if I buy one, That gives me the right to control 100 shares of AMD. If I buy a put contract, one put contract, it gives me the right to sell 100 shares of AMD. So remember that the multiplier is 100 for most options that we're going to be trading. Can change for different kinds of products, but for most options, that's going to be the case. So under 165, we're going to lose $1,220. And above 165, we're going to start making money past 165, technically, but really we've played $6.10 for this option. So our break even is actually 171.10. So here's our break even. We can see the zero P&L line. On expiry, we need this stock to be at 171.10 for us to break even, not including any transactional fees. You're going to have to add that. So your break even could be 171.20, let's say, depending on what your costs are to transact. So our real-time line is going to change because as time passes, so right here we can show that we have a date of May 14th, today's date. What if we move forward? Well, if we move forward, we're going to be looking at a real-time line that's going to change. So watch what happens. As I move the date from 5/14 to 5/17 to 5/18 to 5/19 to 5/25 to May 28, 29, this pink line is starting to move closer and closer towards the expiry line. What does that mean? Well, we have something called theta decay. So this option, because an option has a limited lifespan, it has time value. Under 165, it's 100% time value. And that time value is going to erode over time. And as we get closer and closer to that June 21st date, we can see the time value in this option erode, and the P&L is moving closer and closer to the expiry P&L. Do you see that? Until, on expiry, it's worth exactly what it needs to be worth. There. On June 22nd, it becomes the expiry line. So the cool thing about that is we can see that over time our position is going to evolve. So if this stock sits around, if we've bought this call and the stock sits around for a week and does nothing, well, we're going to lose that value of theta that is coming out of the value of that call. So we can see this right here. $30 a day in theta. If the stock just sits at 160, we're going to lose $30 each and every day. Each and every day. We're also seeing that delta is going to change. So watch what happens with the stock at 160, meaning that strike is now out of the money. We're going to see that our delta is going to move down as we approach expiry. Watch our delta over here. See, our delta right now is 55. Watch what happens as we get closer and closer to expiry. Our delta is diving. It's diving, going to 40, going to 35, going to 25. Why is that? Well, because as time goes by and this stock still sits at 160 or 156 or 157 or whatever it might be, but if the stock sits there and does nothing, the probability of that option being in the money drops, right? As there's less and less time in the lifespan of that option, there is less time for that option to become in the money. And so the probability of it becoming in the money has dropped. So the delta has gone from 45 to 40 to 35. And then right before expiry, if this option is way, way out of the money and we only have a day left, well, the delta is going to be 2 or 3. So some cool stuff that you can see on a platform like this is really being able to monitor your positions, to figure out what kind of position you want to build, and to see how that position evolves over time. And these are very, very important things for us as option traders because we are dealing with instruments that have multiple dimensions to them. It isn't that simple linear relationship that we get with stock. We have multiple dimensions. We have the time. We have implied volatility as well. implied volatility. If the market suddenly decides that AMD earnings are coming up, they could push up the value of the option values in general. That's called an increase in implied volatility. So that's yet another piece that we can't control, but that can impact our P&L over time. Now, the nice thing about all this is when we talk about being option sellers, so let's say we're long 100 shares and we are short one of these 165 calls. Well, look what happens. This chart, this P&L profile gets flipped on its head. Let's put us back to about May 15th. Now here we go. So at expiry, we actually stand to gain $6.10 from this option because we're a long stock and we are now short the 165 call that expires in 5 weeks. We have sold it for $6, which is where the bid was at the time of the trade. And we are going to slowly receive this theta. So look at here, the theta is positive. So on day one, by tomorrow, we should have received about $10 in theta decay from this position of being short one call against long 100 shares of stock, which is called a covered call or otherwise known as a buy right. You'll hear both of those terms used interchangeably. So we are now benefiting. We are on the other side of this trade. The trade, being long an option, was going to cost us money day after day. The trade with a covered call results in us making money day after day. And watch what happens as I move the date forward. Notice that the pink line is starting to move towards that blue line. It's moving towards the blue line because we're getting closer and closer to that expiry P&L, where either this option is going to be worth something or nothing at all. And if it's worth nothing at all, then we've gained that full $6 that we received for having sold that premium. So very, very cool, different scenario for us, isn't it? Versus being long a call, we are now looking at being short an option and benefiting from time and benefiting for having harvested sentiment. Somebody thought, hey, I'm going to pay $6 for the chance to buy AMD at $165. It's trading at $160, but I'm willing to pay $6 to own AMD at $165 because that represents leverage to them, right? If they own one contract of that, then they're going to start making multiples beyond a certain point, beyond that $6 break even, beyond 171. So they're going to start to use leverage to benefit them. But we don't care about that. We are saying we own AMD and we are happy to take in $6 of premium for having sold that call. And that's a very, very powerful thing. We can see that as time goes on, and as we go to June 12th, we see that our theta is now 17 almost instead of 10. So what happens is theta starts to accelerate the closer you get to expiry. It's starting to accelerate. That option time value is starting to dive towards zero. It's diving towards zero because at expiry, there is no longer any time value in that option. So our theta value is starting to accelerate. We're starting to make more and more money from having been short that option. And if a stock trades, closes at 163, let's say, well, we've made $3 on the stock. We've made $6 on the call that we've sold. We've made $9 total. Mission accomplished as a call seller, and life is good. Now, if it goes beyond 165, what happens? Well, we start to give away some of that upside, right? So we've said that we're obligated to sell our 100 shares at $165, but our break even is 171, right? We're getting $6 on top of that strike of 165. Okay, so that's the covered call. So we've talked a little bit about long option positions, short option positions. When you're long an option, you are on the positive side of leverage. So you can buy something for $1, a call or a put that could be worth $3, $4, $5 or more. That is called being on the positive side of leverage. When you sell an option, and let's say you receive that $1, whether it's for having sold a call or a put, the most you can ever make is that $1. It could, however, need to be bought back for $3 or $4 or $5, right? So you're on the other side of the street when it comes to leverage. But this is the choice we have to make. Are we selling options? Are we buying options? Or are we doing a combination of both? A good option trader is going to have somewhat of a balance going on there. A lot of traders, retail traders, tend to be short options. And with maybe a little dollop of long options in there, perhaps for downside hedging and things like that. But a lot of traders do really focus on that short options trade because they like this idea that there's going to be this positive theta that's coming in day after day after day. And while they sleep, in a sense, they have this money that is, in a sense, rolling in from that decay benefit. So are there other kinds of interesting positions? Of course, there's so many different things we can do with options. One that I have listed here, shown here on the screen, is the risk reversal. So what this is selling an out-of-the-money put and using that to fund an out-of-the-money call. So essentially kind of a synthetic long stock position, but we call it a risk reversal. The nice thing about the risk reversal is it takes advantage of options volatility edge. So because people tend to buy insurance for their portfolios, that tends to push up the relative cost of downside insurance. So when people are buying out of the money puts on the S&P, on various stocks, that's pushing up that cost, which makes puts a little bit more expensive. When we sell puts to fund upside calls, we tend to benefit from that skew. We're selling the expensive thing to buy the cheaper thing, selling the expensive skew on the put side to buy the cheaper skew on the call side. That isn't always present. It's not present 100% of the time, but generally speaking, it's certainly the case in index volatility and has been for a very long time. So the nice thing about this position is you might say, well, the SPY is trading at 530 right now, which is right down the middle of our screen here. And you might feel that that's a little bit too expensive. It's had a big run. You might feel like, I really don't want to get in here. But what if it keeps going? Can I benefit to the upside? Yes, you can, by doing a risk reversal. So you can sell the 500 put for $2.28 in this case. And you can use some of that to buy the 555 strike call that expires in a couple months for 187. So we're actually getting a little bit of a credit here. What we're selling is giving us a little bit extra versus what we're buying, 228 versus 187. So we're actually receiving a small credit for having put on this position. And what happens is we effectively have free upside from this call that we've fully funded with the downside put that we have sold. So above, we're going to start making before that, depending on if this starts to move upwards very, very quickly. We can see that in the pink line. At expiry, we're going to have to be above 555 and change because we received a bit of a credit. So we're going to have to be above, say, 549.70 in order to start making money on this position, because our break even is now a little bit lower than 555. So we're going to start benefiting from this position as it continues to go up for free, in a sense. Well, let's not say free, because there's no free lunch in markets generally. What we've done is we've committed to owning the SPY at $500. Do you see that? We've sold the 500 put, which obligates us to buy the SPY at $500 should the market drop below that. The counterparty in the trade, who is long that put, is going to exercise it and put the stock to us. So we're going to own stock at $500. But if the stock doesn't move down through the 500 strike, nothing happens. If we stay between 500 and 555, nothing really happens. We just make our 30 cents or 42 cents here. If it goes below 500, we end up buying it at 500, but we were okay with that. The stock was trading at 530, and we said, you know what, it's too expensive here, but we're willing to own it at $500. Mission accomplished. We own something at a discount to where it was before. And if the market keeps going up, well, we start to benefit from that as it continues upwards and onwards. So kind of a cool strategy there. There are other interesting ones we can do. One's called an iron condor. So this is selling an out-of-the-money put spread and selling an out-of-the-money call spread. We're receiving a credit for both of those. Total, we're receiving $2.13 credit for this. And what has to happen here? Well, this particular stock, Apple in this case, needs to stay within a certain range for us to benefit from the full value of this iron condor. So you're able to do things with options and create pictures and create strategies that fit a certain viewpoint that you're not able to do with just stock. You're able to say, well, you know what? I think the earnings came out on Apple. I think it's going to sit around for a few weeks. Potentially, you could do well on that if it does sit around, if you put on an iron condor and benefit from it in this way. So lots of really, really cool things that we can do with options. We're going to talk about a few more in the next lesson. I hope you've enjoyed this one. You've got a good intro to put selling, to cover calls, to being long options, and we'll see you guys in the next lesson.